I want to consider a very important topic, and I will solicit you watch this video to the end. It will be of tremendous value to you as an investor or a would-be investor. And the topic is why long-term investing beats short-term market timing. Why long-term investing is more advantageous than short-term market timing. Long-term investing is typically more effective than short-term market timing for several reasons, including the ability to ride out market volatility, compound returns, and avoid the risk of making frequent predictions. So here is why long-term strategies often outperform short-term market timing. I want to see precisely, why you need to be a long-term investor. Number one is a market volatility. Short-term markets are volatile and unpredictable. So, and of course, they are influenced by factors like earnings reports, geopolitical events, as well as market sentiment. So these fluctuations can lead to emotional decisions and short-term losses. So long-term investors can weather this volatility, focusing on the overall growth of their investments over time, over many years, rather than reacting to temporary market shift, to market noise, or to distractions. You are a long-term investor. You have a long-term horizon, so you don't allow all these things around, to affect your investment decisions. Number two is compound growth. Long-term investing allows returns to compound. It allows you to compound your results, your returns over time. So by reinvesting dividends, you reinvest interest or capital gains over time. Investors can significantly increase their wealth. Short-term traders, on the other hand, may miss out on the compounding effects as they are more focused on quick gains and might not hold investment long enough to fully benefit from the compound effect. And apart from that, you need to understand that statistically speaking, over 90% of traders don't make money. They don't make money. So long-term investing is better. Number three is avoid the stress of market timing. Avoiding the stress of market timing. So attempting to time the market, buying at the bottom and selling at the top, is notoriously difficult. It's very difficult. Very difficult for one to accurately, predict the bottom. That's the resistance level, the lowest price you could get is difficult to predict. The bottom and the top when it comes to price movements. So even professional investors struggle to predict short-term, price movements consistently. Even those who are highly skilled, professional, experienced investors, they find it very difficult to accurately predict, predict price ceilings and the price bottom is difficult. So long-term investors, however, can avoid this stress of trying to time the market by focusing, on a buy and hold strategy. This approach removes emotional decision-making and reduces the likelihood of making impulsive or misguided choices. So you have the freedom of not being controlled or influenced by short-term market timing, approach to the market. Number four is lower cost. So frequent buying and selling in an attempt to time the market can incur significant transaction cost. taxes as well as a short-term gain. When you sell your position in the short term, it attracts a higher capital gain tax. And when you trade frequently, you discover that it will end up eating into your overall returns. And not only that, and you discover that by the time you take this approach, it will incur higher management fees, because of the level of activity in the market. So long-term investing, typically involve lower transaction costs and tax rates, as gains are realized after holding assets for over a year, qualifying for favorable long-term capital gain tax rate. As told us earlier, the longer you hold your investment, the lower your capital gain, tax will be. Please like this video and subscribe to this channel. Number 5 is historical performance. Historical performance. Historically, the stock market has tended to rise over the long term despite short-term fluctuations. For example, major indexes like the S&P 500, have shown consistent growth over decades. It has been growing, over many decades. So long-term investors benefit from these upward trends, while short-term traders might miss out on the bigger picture or face losses from trying to time short-term market movements. So you might get your finger burns if you want to, consider short-term market movement. You want to trade instead of investing. Number 6 is reduced risk through diversification. Reduce risk through diversification. So long-term investors can take advantage of diversification across multiple asset classes, across many industries, and across different regions or geographies. So over time, this helps reduce the risk, as different asset performs well in different market conditions. And sometimes these assets don't correlate, so they don't really act in tandem. They act independently, and that will serve as a diversifying factor for you. And so short-term, traders, by contrast, often concentrate their bets on a few positions, which can expose them to higher risk. So the more you diversify your investment, the better. If you concentrate on a single position, you are owning a single portfolio, a single stock portfolio investor, then I'm afraid, any negative impact on the stock you're holding will have a tremendous negative impact on your psychology. So number 7 is tax advantages. So long-term investments often have tax advantages. In many tax systems, long-term capital gains are taxed at a lower rate, while short-term capital gains are taxed at a higher rate, or are taxed as ordinary income. And the higher your income bracket, the more you are going to be taxed. This can significantly improve the net returns for long-term investors compared to short-term traders. So long-term investors, stand to gain the more because of the tax advantage they incur because of the duration they hold their stocks. Number 8 is less time consuming. So long-term investments often have tax advantages, and not only that, they equally have the entire process doesn't really consume much time. Okay, and so long-term investing requires less time and attention compared to short-term market timing. So investors don't need to constantly monitor market conditions, news, or technical charts. You don't monitor charts like you just concentrate and focus on charts. Instead, they focus on their on their chosen assets, knowing that over time they are likely to grow. This frees up time and energy for other endeavors while still building wealth. You don't, instead of sitting down, and facing the screen for hours every day, you are tied to the screen. Why not just invest fundamentally and have time for your family, have time for other things that are important in life than just staying, you know, close to a monitor for almost all day long. All right. So, in conclusion, while short-term market timing might seem appealing for quick profits, it is often more risky, costly, and stressful compared to long-term investing. Long-term strategies backed by compounding growth, lower costs, and historical trends are typically more effective in building wealth. People like the richest investor in the world, Warren Buffett, had been investing for over 50 years using a long-term approach. He had been holding the shares of Coca-Cola for many decades. So long-term investing is the best, and I want to advise you key into this kind of approach and avoid quick gains that may not really guarantee you long-term wealth.